The following podcast was recorded on Thursday, June 17th, 2021, featuring Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everybody to Talking Data. I'm your host, Kristen Radosh of Arbor Research and Trading, joined today by our presenters, Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. Great to see you both. Today, we're going to be talking about yesterday's Fed meeting. First topic, of course, inflation. It seems to be everywhere. Are we going to keep hearing transitory? Jim, what are your thoughts?
Yes, we're going to keep hearing transitory, whether it is or isn't, but that word will live on for everybody else. Look, let's frame what the market reacted to yesterday. Is in the Fed dot chart showed a shift towards hawkishness. 2023 in March, the last update, had no rate hikes for 23. This one had 2 rate hikes for 23. In March 2022, only 4 members said that there would be a rate hike in 2022, so the median was still no rate hike. This time, 7 members said that there would be a rate hike in 2022. Not enough to move the median, but we see which way this is going, right? Now we got 2 rate hikes in 23. We got 7 people thinking that there might be a rate hike in 22. So everything's moving in that direction. What we're going to talk about is why. And the first part is it partially inflation? Well, I think it is inflationary driven for 2 reasons. And reason 1 is if you look at the inflation data since the March meeting, it's upside surprise. It's growing very strongly. And a 3-month annualized rate is at 8%. And Powell's language yesterday was a little bit more hedged. Yes, it's transitory. Yes, we don't think it's going to be a big thing, but it's hard to predict because it's a pandemic and, you know, we might have this wrong, but don't worry, we got the tools to deal with this if there is an inflation problem. Where'd that come from? You've never hedged on the inflation story before. And so that's where people are starting to think that there might be a little bit of an inflation idea there.
Yeah, I think too, the SEP showed that they boosted the inflation outlook for this year, and it was by a pretty decent margin. The thing they didn't boost was the growth, the improvement in employment and the drop in the unemployment rate. So I think that took some people by surprise. That they still expect, you know, us to get down to 3.5% unemployment in the next couple of years. So, like, you know, as we're discussing here, the big debate is how much of this is inflation, how much of this is employment, and it feels like the market is reacting to a hawkishness that is somewhat induced by an inflation fear. So the Powell did comment that he believes the supply chain bottlenecks, shortages are causing more inflation and for longer than they expected. So that does either lengthens out this transitory mantra past this year and into early next year potentially. I mean, that's possible. Like you said, Jim, we could be dealing with this annoyance for quite some time. But you know, for me, in the end, it's going to come down to how fast does inflation retreat, if it does, with these transitory factors, and how quick do we get to whatever full employment is for the Federal Reserve, which it appears it'd be around the 3.5% mark, which should happen sometime in 2023. Now, the overall reaction of the market, as we were just discussing, was like classic hawkish reaction by investors. So you have the belly of the curve and treasuries rising, the 2-year, 5-year, 10-year butterfly went positive, appreciably positive by the most since the middle of 2018. That's a kind of a really good leading indicator of moving to tightening. Euro-dollar curve steepened, long end of the curve is dropping. You know, we have 30-year yields getting closer and closer to 1.5%, which is kind of a big deal. And that's because of the Fed potentially about to crimp growth, and inflation expectations are rolling over. So there's a lot going on today, and there's going to be a lot of waiting and seeing still, I think, going forward.
Yeah.
Jim, so what are your thoughts? Oh, sorry, Jim. I was going to ask you next. What are your thoughts on employment? Are we going to still pay people to stay at home?
Yeah, this is going to be the big test is going to be exactly that, because starting at the end of July, which is not that far away, we're going to start to see a lot of these extra unemployment benefits that states have announced that they're going to stop to actually end. So we're 6 weeks away from that for a lot of states, and this is probably starting getting into the window that people that are getting those unemployment benefits, if the theory is people that are getting these unemployment benefits are saying it's better for me to just stay home and collect unemployment, well, 6 weeks out, you better start looking for a job, because August 1st, you're not going to be getting those extra benefits anymore. So we're going to find out whether or not we see an uptick in demand for jobs, because the story has been very clearly that people, corporations have to hire or have to raise wages in order to attract employers. There's a famous story from 2 weeks ago that a consortium of restaurants in St. Louis had a jobs fair, and they had over 100 jobs open at these restaurants, and exactly 12 people showed up to their jobs fair as well too. And of course, the answer is you just got to offer more money to get them in the door as well. So we'll have to see if that is what's holding back employment, is that wages need to go up, wage inflation, or maybe the natural cycle will return once the distortion of all of these extra unemployment benefits come back. That's what the Fed is really aiming for. Remember that they want to see substantial progress towards their goal of getting the 7 or 8 million people that are still unemployed from the pandemic to get their jobs back. As Ben said, they want to get the unemployment rate back down to 3.5%, and then they would like to start raising rates. And hopefully the inflation story will cooperate with them to allow them to do it. And if the inflation story doesn't, they'll have to alter their course.
And I think, inflation's back as the front and center for markets, but I still think employment is still the Fed's, kind of focused mandate for the most part. And what's good for them is that the job seeker, their activity is improving. So you can measure that either via some of the great data that comes out from Indeed, or even search activity like we look at. Job seekers are starting to return ahead of the end of these unemployment benefits. Now, to what degree is going to depend. The space where that's kind of lagging still is part-time, leisure and hospitality type stuff. And as Jim just evidenced, that a lot of that cohort, a lot of that group has kind of been reluctant to return. One, because it's such low wages. Two, maybe they don't like the environment in terms of COVID and safety. And also, of course, some of them getting unemployment benefits. I think that will improve going into towards the end of the summer. And I think the Fed really needs that to happen. So we need to see these, big, kind of a semi-explosive gains in jobs to keep the Fed kind of moving in the right direction. We don't get that. Even if we do have inflation, it starts to becomes a dangerous scenario. Now the Fed, do we have to hike, with a slowing economy and one that's not able to get back the job gains? And again, that is a reason for the long end of the curve to drop. And that's kind of what we're seeing right now. So maybe there's a little bit of that risk in there.
Right. I'd argue too that what you're going to see next is this interplay between what I've called R and I, reflation or real growth, and inflation. Is the inflation numbers are peaking now, right? In the last 3 months, the inflation rate is averaging an annualized rate of 8.25%. It's not going to continue at 8.25%. If it did, that would be a big story. So it's going to back off, but back off to where? Is it going to back off to 2.5 or 3, or is it going to back off to 3.5 or 4? 3.5 or 4 is a problem. 2.5 to 3 is not a problem. And along the way, as it continues to back off, if you get bigger spurts of employment, some big payroll numbers here, I think the Fed will be a little bit more willing to tolerate the inflation side. But if we continue to see, like we have for the last 2 months, disappointments in employment growth and 3 handle on inflation, it's going to make, I think, the Fed very uncomfortable. We're not getting anywhere on your employment objective, but we've got this inflation problem as well too, and that's going to really change policy. So bottom line, what I think with the Fed is and even Powell said this yesterday, is that they are not thinking about tapering. They are now in the position of thinking about tapering. That is, I don't know if that qualifies as a policy shift. I'll let the data scientist Ben tell me if he qualifies that as a policy shift. But that's what we're at right now, that we're in the thinking about tapering scenario, and whether Jackson Hole means the next step or somewhere in between remains to be seen.
Yeah, I think it really does, though. So based on, if we're getting fancy with some of our natural language processing of their rhetoric, when we model out, take what they've been saying and model out where should the U.S. shadow rate be, which is basically the target rate accounting for the purchases, and that will also account for tapering, meaning that they rise. If that's somewhere around, negative 200 basis points or so, their communications are saying that we should be back towards 0 basis points sometime in very early 2022. So that still fits the theory that, around Jackson Hole, maybe shortly thereafter, we'll get the tapering discussion to really heat up and maybe even announced, and then we get the tapering in early in the year. And I think that's what investors are more or less, setting up for. The goofy thing that's happening right now is that the inflation outlook is suddenly shifting in the past couple of days, or really since the Fed meeting. So you have investors no longer pricing in 2.5+% headline inflation for the next 5+ years. Now that either is going to expose a big risk for investors that they've kind of priced that out. If we do get the regime shift like Jim's talking about, where wages, rents, and so on come back, and we have some moderately high inflation, investors are going to have to price that in right away again. But on a global scale, it's all of a sudden, like in the past number of days, that the error in the inflation story has just started to come out. Europe's doing the same thing. All of a sudden, investors looking at their inflation swaps, caps, and floors are pricing out 1.5% inflation. They're starting to get hesitant. Now it's less than 50%. So the Fed matters. Unfortunately, all of this matters because they're kind of changing the wavelength and really the thinking. And like Jim was talking about before this call, we're back to an environment with treasuries and the bond market where the Fed is critical. And so on these Fed days, we're getting these big moves, and then we go into the land of nothingness. And this is akin to, earlier in our careers when non-farm payrolls going into the financial crisis was just critical. You get all this, you get big non-farm payrolls, miss or beat, and that's where all the vol was, then it'd go away. And I think that's what we're kind of back to now. Everything's the Fed, and when they talk, there's gonna be big moves, and then when they don't, it's going to be boring.
Yeah.
So Jim, can you summarize with your views on the bond market?
Yeah, so I think where the bond market is we're at a crossroads right now. Are we inflation? Are we getting real growth? Which one are we getting right now? And if I look at the technical patterns in the market, you've had a big run up in yields from last summer. And again, I think the bull market in bonds ended in March of last year. So you had this giant run up from 33 basis points last March to 1.8% at the end of March of this year. And now we're waffling around 150. Technically, the sideways type patterns are what are called continuation patterns, that the larger trend remains up, but you just kind of churn sideways. Another way to put it is the old saw on Wall Street, the market moves to the level of most confusion, and this is the perfect level of most confusion. Everybody wants the market to do something. Go down in yield. Tell me there is no inflation. Go up in yield. Tell me there is inflation. And all you ever do is just print between 150 and 160, and everybody's like, just do something. And it just continues to go sideways for an extended period of time. That's where I think we're going to be right now. But if I had to say, which way do we break out? I still think we're going to break out higher. I still think that what we're going to find is, no, we don't have 8% inflation, but we're going to have an uncomfortably high level of inflation as we move forward from here. If we especially don't get the employment jump that everybody wants, I think there's going to be a movement in Congress to mail more money. That's always been my rhetorical question is, well, we send out everybody money and we've stimulated the economy and that's why we got inflation. And I've always said, do you think we're done sending out money, that's over? If the economy slows, I think that we could see more money be sent out. And that's kind of the basis of where I think the inflation is going to be. Now, if the Democrats that run the House, the Senate, and the presidency come out and say, no, we've sent out enough money, and even though the economy's slowing, there's not going to be any more checks, I'll adjust my view otherwise. But the way I structured that, you can tell which way I think it's going to go. and it remains to be seen which way we go. So sideways action, breakout higher, and I think inflation will be uncomfortably high. I use that word uncomfortably because no, I'm not in the inflation, in the hyperinflation camp or the high single digit camp or anything like that. In a 150 world with uncertainty, a 3 handle on inflation with these big negative rates, negative real rates, is a problem for the bond market. And that's all I need in order to say, yeah, we'll break out of this range and go higher in yield.
Let me say one more thing real fast too, because so fitting along that, exactly what you said, Jim, is if you look back at history at all global recoveries since 1950, I mean, it is just, it's uncanny. It's kind of funny how similar yields have moved. We got that pop over 150 basis points and move in yield, and it's kind of right on par with historical rebounds, from just dastardly poor growth. And I think we have something like 13 or 14 of them since 1950. But at this point, since we followed that same path, the 10-year yields typically go sideways for almost a period of 6 months habitually after global recoveries. And then they ultimately resume either, well, in most cases, lower. But there are some instances when you go back pre-1995 that we've been tracking much more closely that do continue higher, and TIS break-evens have been able to add even more and widen further. So again, it gets back to, like you said, is it the R or the I? Which path are we following? More this pre-1995 or this post-1995? But regardless, no matter what, in all those situations, we've gotten this period of congestion, sideways, confusion trading that goes on, endures for somewhere around 6 months. So we could be in store for that. So I agree, Jim. We shouldn't get too wild about breakouts in either direction and think that this is like there's a substantial trend shifts exactly happening. It could be just a nasty range trade for a while.
Yeah, just a final thought on it. The psychology seems to really be range trade because, if you look at the last month, bond yields or 10-year yields print in the high 160s. Oh, hyperinflation. And then it prints 150 or 149 and it's no inflation. It's like, wow, 16 basis points matters that much. That's what you do in a range. That's what you wind up doing in a range. You swing the motions wildly from one end of the range to the other end of the range. And that's what really frustrates everybody because it seems like the story just dramatically changes all the time and the yield never changes.
Right.
And I think, like we said, more of that. So you said 6 months, Ben. We're what, 2.5 or 3 into it? We're only halfway through it right now.
Exactly.
What that says. So enjoy the sleepy summer in sideways interest rates.
Right.
Well, thank you both for your thoughts today, and thank you everyone for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our 2 most prominent offerings are Bianco Research and Arbor Data Science. For further information, please contact Gus Handler at gus.handler@arborresearch.com. Have a great day.